Well, good afternoon or morning, wherever you are in the country. This is Dave Greene with NIW. Today we'll be talking about Tri-Zen, which is the next step in the line of the Kaizen strategy. And hopefully all of you that are on board today have a keen idea of how Kaizen works. Tri-Zen is a little different, but it falls under the same contract as Kaizen. So with that said, I wanted everyone to understand that it's an executive incentive strategy. I'm going to be a little redundant because it's very important that you understand exactly how the premiums are paid. So when you talk about Kaizen, Tri-Zen is no different other than the fact that we pay the premiums to the employee or the participant in a little different way. But it opens up so much when it comes to the benefit planning arena for nonprofits and C Corps. And so I'll kind of get right into that, and I'll give you some examples of how it might look in certain different situations. But with that said, let's get started. First of all, I want everyone to understand basic concepts that we'll be dealing with today. And so I have a little quiz for all of you. The first question is, on a scale of 1 to 5, 5 being the most important, how important is saving for retirement to you? So I would ask this to a client, knowing that if it's a 1 and it's not very important, I would probably move on and ask questions about what their needs are other than supplemental retirement planning. Because if they're not interested in saving for retirement, you might as well just forget this strategy. Number 2, if you borrowed $50,000 from a bank, would that money be taxable to you? Hopefully, if you're writing the answers down, you would say, no, it would not be taxable to you. Number 3 would then be, would that money that is borrowed be considered compensation? Well, no loans are considered compensation because it has to be paid back. Now, number 4, if borrowed money was not taxable, what percent of your income would you change from taxable to a tax-free loan if you didn't have to pay it back or even have to pay interest on it? Well, everyone that I've spoken with have said all of it. So in other words, you would want all your salary to become tax-free if I didn't have to pay back the loan. Exactly. Which brings us to number 5. What would be the percent of income then would you invest if those borrowed funds could only be used for money toward retirement savings? In other words, you have to live every day on a certain amount of money, but this money would be earmarked toward retirement, but you would still get the benefits of the tax-free growth and tax-free to you. Now, how much would you invest? And you were only given the next 5 years to invest this money. Take it or leave it. You got 5 years. And the funds grew tax deferred. Income could be taken out on a tax-free basis. You received a market-like rate of return, which everybody likes. And there was no downside interest rate risk, so you had safety built into the plan. Now, the funds were actually liquid, so you could be your own bank as well. And you would receive 3-to-1 matching funds without having to sign any document. And then, of course, you could obtain cash in the event of death or illness. Now, if you could borrow money to do that and not have to pay it back, how much would you borrow? Well, you would probably borrow as much as you could get your hands on. And that's basically what Tri-Zen is all about, borrowed money for premiums. Now, Index Universal Life, of course, was created to provide growth and income. Now, we do have a life insurance component which gives us all of our tax efficiencies. With that in mind, wouldn't it make sense to uncover and develop the client's need for supplemental income? Yeah, when we do our fact-finding and we ask questions, we have to uncover their need for income. If we skip this step and go right to our strategy, we're going to miss the vital step. So do your fact-finding before ever recommending a solution. Now, if you don't do your fact-finding, you'll be thrown into the category of a salesperson rather than an advisor. And you want to be an advisor, especially in the corporate market, because if you left out of meetings because you're a salesperson rather than an advisor, you miss out on what's going on. So make yourself an advisor. Now, what do you think comes into a client's mind when investments are mentioned, let's say at a party? Well, do you think life insurance is mentioned? Not too often. It's fairly mundane. And if your clients are listening to Susie Orman, Dave Ramsey, or maybe even their CPA, what are they hearing? We have to get ourselves into the mind of our client, and we have to understand what they're hearing when we're not around. Well, they're probably hearing never use life insurance as an investment. It could be they hear always buy term and invest the rest. And I know our clients are hearing that. And so I would ask my client, have you heard of term and invest the rest? And they would say yes. And I would say, you know, I believe in that as well. I think you should buy term and invest the rest. But what do all life insurance products have in common? Well, they all have mortality charges. Every month, every year, charges come out for the cost of the mortality. That's kind of like term insurance. So in other words, every policy starts off like a term policy. Now, it's not considered a term policy because there's no term at the end. In other words, it's not 10 years, it's not 30 years. So it's a permanent policy, but it acts like a term policy as far as mortality is concerned. You know, the difference is in the product is merely, number one, how much premium is paid in excess of the term cost. So in other words, if we're looking at term and invest the rest is excess over the mortality cost. Number two is how that excess premium is invested. If it's invested in a whole life contract, they may offer a dividend at the end of the year, and that's the excess growth. If I have a security, like a variable product, it's a separate account from the life insurance carrier, and it has risks associated with up and downs of the markets. Okay, so what's the point? If all policies are like term policies and you're already paying for term, then the question should be, what's the rest? Now, if you're looking for income in the future, which in the first question of the quiz, I said, how important is it for you to save for retirement? If it's important, well, then you're looking for income in the future. What's the best vehicle to use with the funds in excess of the term cost? So let's make up the ideal vehicle for the excess. Now, when deciding on this growth strategy, what would you want it to look like? Would you want deductibility, or do you want it pre-tax coming to you? Well, everybody in their right mind would say yes. Now, I would offer this to my client without the check marks and let them put in the check marks for themselves. Would they want tax-deferred growth? Well, of course, everybody wants that. Do they want tax-free income? Well, they'll say yes, but now they're starting to question what this product is. Do they want it market-driven? Well, of course they do, but they're afraid of the risk, even though that's about the only place that you can get something with a decent rate of return, but there's always that downside risk. So let's give it safety. Do you want no downside interest rate risk? Well, yeah. Now they're really confused about what the product is, but they'll say that they want that. And they all actually are thinking they're probably getting set up right now. Do they want liquidity? Oh, of course. Everybody wants to be their own bank. How about matching funds? Imagine for every dollar you put in, we will put in an additional $3. That's pretty amazing. And without having to sign for anything. Yeah, of course they would want that. How about cash in the event of death or an illness? Imagine getting a heart attack and you couldn't work anymore, so your income stops. Where will you get that money? Imagine if this contract would pay you up to, let's say, $1 million if that occurred. Well, of course, I would want that. Well, I would say to my client, I can get you all of these benefits in one package, with the exception of maybe one. What do you think that is? Deductibility or pre-tax. Now, what I would say to the client, it depends on who pays your salary. That will depend on whether or not you get it pre-tax. If you have a pass-through entity, a LLC, an S-Corp, a partnership, that's a pass-through entity. If you're being paid by a pass-through entity, I cannot give you the pre-tax premium. However, if you're paid by a C-Corp or a not-for-profit, I can make this pre-tax to you. This is something they're not familiar with. Pre-tax, tax-free income, the two things that they want in their growth vehicle, but I can give that to them. Now, what is Tri-Zen? Tri-Zen is actually a premium finance strategy. It's used to help provide a substantial amount of supplemental income, which they were wanting, on a tax-deferred basis, which they wanted, to selected key employees of a C Corp or a not-for-profit entity. Could be a university, could be a ballet unit. It could be anything that's a not-for-profit, or it could be a C Corp, could be a manufacturing company, could be a publicly traded company. Now what you're seeing here, I'm saying employee. So in other words, it's kind of a relationship between an employee and the corporation. It's not a corporate benefit per se, however, but a unique way that the corporation can help an employee contribute to his or her own plan. And think of that own plan as a Kaizen plan. So in other words, a corporation can help an employee contribute to a Kaizen plan. It has the same structure. It's how they pay it, though. That would be great for the employee. Now, just like Kaizen, the Tri-Zen contracts are also controlled by the employee, with the owner being the employee's trust, just like Kaizen. Whereas the Kaizen premiums are paid on an after-tax basis, the Tri-Zen premiums are pre-tax because they're loaned from the employer to the employee's trust. And you saw when we started, are loans taxable? No, they're not. So the loans come to the trust pre-tax. Now, because they're not taxable, because they have to be paid back, the full loan is able to go into the policy without any income or payroll tax. So in other words, imagine if you had a client that was interested in $50,000 a year into Kaizen. Well, that client in a 50% tax bracket, it's easy to calculate, would have to make $100,000 to net 50. Well, if the corporation decides to loan them the 100 instead of pay them in salary, that full 100 will go into the Kaizen plan, and it will get matched by lenders on the full 100 instead of the 50. So I'm able to double up all the benefits just by loaning the money to the employee. Now, all loans are just that. They're loans. They're not considered compensation, so they'll generally not be construed as deferred compensation. Note the word compensation. It is not compensation. Here's the kicker. The documents are drafted to state that the loans are to be paid back at the death of the employee. Now imagine what happens on that situation with the $50,000 a year into Kaizen. Let's say it buys $1.5 million of coverage. Well, if I loan the 100 to the client to buy the policy, that pushes the death benefit up so that it doesn't create a mech. And so now I have $3 million of insurance, but I've doubled up my premium. That extra $1.5 million is more than enough to pay back that premium at the death of the employee. Thus, the employee's heirs will have a sizable amount of death benefit as well. All right, regardless of the design, all contributions to the trust are paid by the employer in the form of a loan. That's redundant, I know, but I got to get it in your mind. And can be funded one of three ways. One, additional employer funds. This is where an employer says, we really value you, we want to retain you, we're going to put in $25,000 a year into a Tri-Zen plan. So that's additional to what they're currently being paid. Now the employee might say, well, this is a really good deal. What if can I put my own money in? That's number two, employee funds. Now they could put money in lieu of compensation or any other employee benefits that they're receiving, such as a 403B. In this situation, the employee says, well, shoot, I want to put in $50,000 a year. What do I do? Well, if you're making $300,000 a year, we'll reduce your salary to $250,000, and we'll take that $50,000 that you want to contribute, and we'll fund the Tri-Zen for you in the form of a loan so that it won't be taxed. Now, the third option is any combination of the two, whereas an employer might say, I'm going to put in, and I'll show you examples of this, but the employer might say, we'll put in $25,000, you can put in any amount that you want in excess of that. Now, because it's not governed under ERISA, I have no limitations on how much I can invest. So I can put in any or all of my salary. That's any combination of the two. It's very flexible, so you'll find that the design phase of this is the most critical part, where you're talking to a corporation on exactly how you want to structure it. In any case, the employer's contributions, loans, are booked as a receivable or an asset and will earn interest based on what's called the applicable federal rate. That's the AFR rate. This was established in 2004 when the IRS changed the rules governing split dollar. Now, this is technically a loan regime split dollar. So with loan regime split dollar, the IRS said you're going to have to pay interest on that loan based on our tables. Now today, and we use the long-term loan rate, the long-term rate is just around 2.86, and it changes monthly. But once I pay that, or I get that loan, I can lock that rate in for life expectancy less 1 year. So if I have a 35-year-old life expectancy, I can lock that in for 34 years and then renew at the end of 34. So that's a fairly low rate that I can lock in to receive money. Now let's look at the design flexibility. In its most basic design, an employer uses additional corporate funds to loan the 5-pay, remember, it's Kaizen, so it's a 5-pay, into the employee's trust. Think of that loan as a corporate investment that's earning a fixed rate of return, let's say 3%. So the AFR would be 3%. Now that's kind of like a bond. In other words, you could say that any loan that you're giving out as a corporation can be construed as a 30-year bond at 3%, and it's an asset. So if the premium was $50,000 for 5 years, the corporation would be earning 3% on the money that's loaned. So in 5 years, they would have loaned $250,000. So that corporation knows that they're receiving $7,500 a year as a way of benefiting the employee to recruit and retain. What a great way to do that without having to provide an expense where it's gone. Now the document states that it's not a demand note because that would bump up against deferred comp rules. So the note will be paid back upon the death of the employee. Of course, the advantage to the employee is that the loan is not taxable. And because it's not considered compensation, there are no longer payroll taxes withheld. So that helps the employee because they pay payroll tax, and it helps the employer because they also pay payroll tax as well. So that's eliminated. Now in the second design, the employer decides not to help fund the plan, but allows the employee to contribute on their own an unlimited amount of current compensation to fund their own plan. So they say, Bill, you're on your own. You can do whatever you want, but we'll loan it to you if you want. So if the employee was making $300,000 a year, they could amend their compensation agreement to receive $250,000, and the corporation would take that additional $50,000 and they would pay that as a loan to the employee's trust in the Tri-Zen model. Once again, the advantage to the employee is that the loan is not taxable and paid to the trust on a pre-tax basis. Of course, to the advantage to the employer is that the $250,000 loan has come from funds that were once to be paid as compensation along with payroll tax, booked as an expense, and gone forever. Now it will be booked as a receivable and will be eventually recovered with interest. Not bad. Now a lot of times maybe one of the employee or employer administrative people will say, well, wait a minute, we don't want to wait 35 years to get our money back. And I say, well, you can continue to pay the $300 and it'll be gone this year. You'll never get it back. Well, that kind of stops that line of questioning. A third design could be created in an effort to obtain guaranteed issue, which is the ultimate. That's what we're trying to strive for. Now, to obtain GI, carriers will usually want a specific minimum number of participants as well as a high percent of participation. And it's different with different groups. So in other words, on a rule of thumb, if I can get over 30 people and have a 90% participation, I could potentially get guaranteed issue for that group. The key is participation. If it's a voluntary program, you'll never get 90%. However, to achieve that high of participation, the employer would normally have to, what I call, prime the pump and offer corporate dollars as an enticement to participate. And you're going to see it's to the advantage of the employer to provide this enticement. Here's the example. An employer could offer each participant as little as $15,000 a year for 5 years into the Tri-Zen model. And that allows the employee the option of contributing an additional amount of their own funds, but it primes the pump. It gets the employee to say, of course I'll take the $15,000 because I don't want to say goodbye to it. So I'll start with that. Now here's the advantage of the employee. The initial $15,000 of those funds goes almost all the way in covering the mortality and expense of the plan. Any additional employee funds only serve to grow the cash value at the current crediting rate, all with a pre-tax contribution. So in other words, if the corporation is taking care of my mortality and expense and I put in an additional amount, it's only going to earn the crediting rate because the mortality and expense has already been taken care of. Now let's look at the advantage to the employee. They're not only receiving interest on their 15 grand, let's say at 3%, but they'll also be receiving interest on the contributions the employee will be making because it too will be a loan from the employer. So here in this example, let's assume that the employee contributes $30,000 a year on top of the 15. Because the money, because this is money the corporation would normally have paid out in compensation, now it becomes an asset earning 3% for the corp. Sweet. Corporation's $15,000 investment is now earning 3% on their 15 plus 3% on the employee's 30. So I could look at this as a 9% return on the employer's contribution of $15,000. Now, where else could they invest $15,000 and get 9% guaranteed until until the death of the employee? It's really good. Here's the moral of the story. The more the employee contributes of his or her own money, the better it is for the employer. They're going to push the employees to want to do this because they want them retiring on as much money as possible. Now, we get into, that was kind of nonprofit talk. We can also get into the C Corp arena, and there's a little difference. Now, Tri-Zen, of course, is an arrangement between an employer and an employee. The employer, and this is redundant, I'm sorry, but the employer loans the premium to the employee's trust in the split dollar arrangement. Now, my question would be, are loans deductible to a C Corp? If a C Corp loans money, is it deductible? No, it is not deductible. Is it deductible to a not-for-profit entity? No. Then the question becomes, who cares about a deduction? Does a C Corp? By all means. How about a not-for-profit? They really don't care because they don't pay taxes, so they're not into the deduction element of the program. So let's assume a $1,000 bonus to a key employee. What's the net cost to a C Corp? Well, I've got $1 million in compensation that gets paid out. If I'm in a 35% tax bracket as a C Corp, I get a $350,000 deduction. And that leaves me with an expense and negative cash flow of $650,000. That's what they paid. It's gone. That's what their negative cash flow would be. Now, what's the net cost if it's loaned? So once again, we loan the money out. It's out there. However, we do not get a deduction, so we actually have to pay Uncle Sam $350,000 to the expense of the tax. That leaves us with $1,350,000 of negative cash flow. Now, what's happened here? Why would a C Corp want to give up a $350,000 deduction? Well, to reduce the expense while creating an asset. In other words, their expense is $650,000 over here, It's 350 here, so they save 300,000 in expense while picking up $1 million asset. So you have to say, which would be better for a C Corp CEO? A 650 expense or $1 million asset? They will always take the $1 million asset. Why? The CEO's job is to grow the stock price for the shareholders. Now, reducing expenses increases earnings and the stock price. Now, there is one reason why they won't do this. If they have really no cash flow, their cash flow is poor, they will always want the deduction. If their cash flow is good, they'll always want the asset. Now, they're also, the ultimate reason they're doing this is to retain an employee. So they have to weigh that as what's the cost of keeping that employee. Now here's a question. What if Trump gets his 15% top tax bracket? Does that help or hurt the corporation? Well, it's quite surprising when you look at it, because where we are today, the corporation is in a 35% tax bracket, so they get a 35% deduction on expenses. So here they would have picked up a deduction of $350. However, if we go to 15%, their deduction goes from $350 down to $150. So they lost $200,000 in deductions, which they pick up as an expense. So their expense increases on the books. It does not help them. But it really helps them if they're going to loan the money, because now, because the $1 million is taxable, they're only going to pay tax on $150 instead of the $350 up here. So I've saved $200,000 should this happen. And I'm not going to get political whether it'll happen or not. Okay, would Tri-Zen work for a pass-through entity? No tax advantage. The example I use is if I have, let's say, two partners in a C Corp, if they loan each other money, that money will pass through to them. They'll have to pay tax on it as ordinary income, so there's no real advantage. In fact, why would they want to pay loan interest or accrue loan interest when they could just buy the Kaizen with their after-tax money? And that's the issue behind pass-through entities. However, what about contract workers like Form 1099 employees? And I'll start, yeah, of course. I'll start with doctor groups, in other words, professional organizations. Many times they're set up into what are called, in the physician marketplace, they're set up in what are called PSAs, or professional services agreements. So what they do, they contract with a hospital. I could have a doctor group of 50 doctors that contract with the hospital to perform services. The hospital then pays their pass-through entity, or their PCs, let's say X amount of dollars. Once it's in the PC, in order for the doctor to receive income, they have to take it in the form of salary or compensation. So let's look at doctor groups with a PSA, professional services agreement, without Tri-Zen. Here's kind of what happens. I've got the professional group here. The hospital will make payments to the professional group. They, in turn, will have to pay their doctors as taxable income, and then that doctor would probably want Kaizen as a way of providing for after-tax income. Now, with Tri-Zen, here's kind of what happens. The hospital now, instead of paying the corporation, will loan each employee an X amount into their personal trust. Now, by doing that, the employee receives it pre-tax. We've cut out the corporation. The asset is controlled by the doctor, and they are allowed to take tax-free income off of their trust. On the other hand, over here with the hospital now, rather than paying it out and gone, these are now considered loans to the hospital, so they'll get the loan and the interest back to the hospital at the death of the employee. So it becomes an asset on the hospital's books. That's not bad. Now, the organization over here then decides how much Tri-Zen they want and on whom. So in other words, because it can be discriminatory, each individual can decide if they want to do it. So if I have 50 doctors, maybe 40 want to do it and 10 say, no, I don't have the capital, so that's fine. We do it on 40. All right, now We also want to look at those receiving endorsement money, and they're all over the place. We just have to be cognizant of it. So I take an example of, here's Adam Scott. He's a great golfer. He's wearing his Titleist hat. So I would assume that he's making money for wearing that hat, and he's endorsing the product of Titleist over here. So here's what happens is Titleist will cut the check to Adam. It's deductible to the corp, and all said and done. It's after tax to Adam Scott. Now, if we use Tri-Zen in this model, what happens is Titleist will loan pre-tax payments to the endorser's trust or to Adam Scott. So Adam now controls the asset, and it becomes a tax-free income to Adam on a pre-tax basis. So he doesn't pay the tax. Let's say it's $1 million. He won't pay the tax on that. Now over here, Titleist picks up that asset on the books, and so they know that they'll recoup that. So if it was $1 million a year for 5 years, they just picked up a $5 million corporate bond, 30-year, and it's going to get paid back with interest. Not bad for the C Corp. That, my friends, increases their stock price, and the CEO is very happy. Okay, all the loans, of course, go back to the corporation at the death of Adam. Sad day. Now think of the possibilities on endorsement money. There's a lot of ways you can go. You can look at all the manufacturers out there, whether it be clothing, athletic equipment, autos, beauty products, anything that's advertised. They usually hire people to endorse their products. They could do Tri-Zen. Of course, athletes are a shoe-in. They could all do Tri-Zen. And entertainers. Any market that you're in, we have a whole new strategy for them. Now, I'm going to go into the not-for-profit side again, and I'm going to look at a specific example. And this is the university and the coach. I put my Hawkeye logo on here as a diversionary method. It's not Iowa that's doing this, but it is somebody. Here's the fact pattern. I have a 45-year-old coach. The university's worried about losing them, so they have to provide something to maintain that coach. What would be the best way to retain that asset? Well, they were thinking, let's do an additional 5-year bonus of $300,000 a year. So we would look, are there alternatives to that? Sure, we could do deferred comp using $300,000 a year that's controlled by the university. Or if it's a 5-year bonus, that we have a shot of getting a Kaizen case on the 5-pay. So in other words, once he's received the bonus money, we sell him a Kaizen 5-pay program. Or we could use Tri-Zen using a 5-pay. So let's look at these 4 options that this coach has. First is the bonus. As we know, the university cuts a check for $300,000 a year. Taxes, let's say 40%. I've got $180,000 a year to spend into something. That's $900,000 over 5 years. Let's put it into some investment, and let's say it's a mutual fund. Then we have deferred comp. Deferred comp, the university holds on to the $300,000 and invests it. No tax until it's received. Now that $300,000 a year now will total over 5 years of $1.5 million, and that will go into an investment. But it's invested by the university, so they're subject to forfeiture. So in other words, this money could go away if the corporation went under, or the university. That's number 2, deferred comp. Now let's look at Kaizen. Kaizen is an after-tax cost. So once again, the university would cut a check for $300,000 a year. You've got the taxes. You've got $180,000 a year, a total of $900,000 going into the coach's subtrust. Now, of course, we would put it into Kaizen, but you know that we have leverage on top of that. So a lender will come in and they'll add about $195,000 for the first 5 years, $373,000 for the next 5 years. So there's an additional $2.8 million earning money for us in the Kaizen vehicle for a total premium of $3.7 million. That's why we love leverage. All right, let's get into Tri-Zen. Tri-Zen, You take the university because it's not for profit. I'm not worried about deductions, so I'll loan $300,000 a year. No taxes. Total 1.5 goes into the sub-trust. Now I've got 1.5 instead of 900,000. So when we put that into the Tri-Zen growth vehicle, it's no different than Kaizen. It gets leveraged. So now we have a lender lending to 1.5 instead of 900,000. So we've got 328 going in for the first 5 years, an additional 627 for the next 5. So I have a total of 4.7 million working on my behalf in there. That's a total premium of $6.2 million versus 1.5 in deferred comp. All right, what just happened? Well, let's look at the net, and I'm saying net after tax, employer or employee contribution. With the bonus, the net was $180 a year. That's an after tax. Deferred comp, I got the full amount going for me. Kaizen, after tax. Tri-Zen, pre-tax. So you can see what's happening here. Now the total for the 5 years, 900, 1.5, 900, 1.5. Let's keep going. Here's the university outlay. It's the same, 1.5, 1.5, 1.5, and 1.5. So here's the bank loan now. 0 with the bonus, 0 with the deferred comp, 2.8 with Kaizen, 4.7 with Tri-Zen. Now remember, I'm using the same money to do all this. Here's the total contribution, 9, 1.5, 3.7, 6.2. Boy, that's just amazing. But let's keep going. I can't stop now. Here's the initial death benefit. Do we get a death benefit and a bonus? No. Deferred comp, I could invest it in a life insurance policy, but that would reduce the income that would be spawned off. So let's not do that. Kaizen automatically comes with 8.5 million of death benefit. Now, of course, Tri-Zen, because I'm putting in more money, will bump up the death benefit to $14.3 million. That's a nice little added feature to this investment strategy. Now, here's where the rubber meets the road. Cash value at 65. The bonus, I'm going to put that into a mutual fund earning 7% with a 1% management fee. I would come up with $2.4 million at 65. Deferred comp, well, more because I'm putting more money in, but it's still in the hands of the university. Kaizen, 3.1, less than the deferred comp, but more than the after-tax bonus. So is the one with the most money the winner at 65? No, it's what you can draw from the contract. So Tri-Zen, of course, just exceeds everything. 5.2 million of cash value at 65. That's after the loan's been paid off, by the way. Okay, net income at 65. Well, once again, let's take out $144,000 a year. I'm going to assume a 20% capital gains tax because I didn't take tax while I was growing. Then the deferred comp is taxed at ordinary income because I never pay tax on that. So I can take out 183 more than the bonus because I have more money to draw from. Now what could I take out with Kaizen? Well, I can actually take out $350,000 a year. Not bad. I can, how about from Tri-Zen? $510,000 a year. Now what you're saying is I'm taking far more than what this is spinning off. So this will crash, won't it? And this, I'm not taking enough. I could take more. Well, let's look at the cash value at 90. I'm going to take income to age 90. What's left? 831, so I've drawn down. $1.1 million, I've drawn down. I've taken 350 here, started with 3.1. It's got to be 0 at this point, doesn't it? No. There's 8 million left in the account at age 90. I haven't even taken the interest growth. So I'm very conservative about how I illustrate these. Tri-Zen, there's 18 million left in the account. Now the point I'm making is that we could start at any amount that we wanted, and we want to manage these funds every year depending on how well the account is doing. Some years he may take 510, other years he may take 700. Maybe he could take 400 one year. So we want to manage that so that it continues to grow, because I'm a scaredy cat when it comes to growth, and we don't want these things to lapse. So we don't want to take more than what's available to us. Now, what just happened for the university? Well, let's look at expenses. The bonus was a $1.5 million expense, no asset. Deferred comp, same thing. Tri-Zen, same thing. But Tri-Zen, completely different. The Tri-Zen has no expense, but becomes a $1.5 million asset that's earning interest. Now, the bonus doesn't earn interest. Deferred comp and Tri-Zen don't earn interest, but the university is making $45,000 a year by doing this on behalf of the coach. Amazing, huh? Now, let's go to a group that has a PSA, and I call them radiology wizards. And they have a professional services agreement with a hospital. Here's the fact pattern. They are an LLC with 50 doctors, and the average age is 47 years old. Well, they're unhappy with their current qualified plan as well as those available to them. And they're being forced into individual after-tax programs and investments. And they currently have a PSA with God Hope Hospital. That's a not-for-profit paying the LLC $10 million a year. What are the doctor's options for generating sufficient retirement income? Well, same fact pattern. Taxable bonus, let's say 50 grand a year. Deferred comp, 50 grand a year. Same, Tri-Zen, Tri-Zen. So I can do the same one of these on each employee. So in other words, if I'm going to do 50,000 a year, the bonus will give me a net 30, 50, 30, 50. Contributions, same. Outlay, same. Loan, you know what's happening with the Tri-Zen and Tri-Zen. Total contribution, much more in the Tri-Zen. Now this is each employee of 50. Let's keep going. The death benefit, $2 million with Tri-Zen. Cash at 65, once again, it extrapolates the same no matter how you do it. Net income at 65, $76,000 a year. Not bad. And of course, cash at 90, $1.9 million. So I'm way ahead of the game. I'm very conservative. Now, how has the hospital fared? So the hospital says, okay, if I put a bonus, a deferred comp, or Tri-Zen, it's all after tax, it's an expense, I have nothing for assets. Here, for each individual, they have $250,000 after 5 years, which is netting them out $7,500 per year as long as they're living. Now, if I incorporate the number of lives, I have 50 employees that are each doing $250,000, then the hospital has contributed over 5 years $12.5 million. That's $50,000 a year times 50. And now they're making $375,000 a year in interest off of this plan that they would have earned nothing and gone. Now, if you want to look at target premiums, because of the fact that we are paying more into Tri-Zen, which pushes up the death benefit, we take the 30,000 by 50 lives, target 762, target for the Tri-Zen $1.4 million. So that's kind of a nice case. And they're all over the place. And I have to explain, you know, my wife was in the hospital last month. She's doing fine. But it wasn't a bill, but I received a statement from the hospital, and it said to me that it says bills you may receive. You may receive separate professional billing statements from other doctors or medical specialists who assisted in your care. So please contact them directly. And what do? They gave me all of the PSAs that they're working with. The radiology group, anesthesiology, pathology, neonatal, emergency specialists, the medical group, the Center for Cancer Care. These are all organizations that are separate from the hospital that have PSAs with the hospital, and they gave me their phone numbers. So I basically have, I have 8 leads to go after right there. All you would have to do is look in your yellow pages or on Google, who are the corporations that do business with the hospitals, and they're all going to have PSAs. So all of these organizations are sitting on gold mines, and they don't have a clue that it's out there available to them. It's just utterly amazing. Now, here's the summary today. Determine your client's needs first. Do your fact-finding and offer a compelling solution. That's your recommendation. You then become an advisor to these people. Okay, hopefully everyone understood this. So I'm going to open it up for questions. And let's see, I'm going to stop recording right now.